Hi everyone, welcome back. As usual, I'm here to share with you my weekly views for the market and both technically and fundamentally. So let's start by sharing and taking a look at the calendar. And it's worth mention, of course, that we have a bunch of data this week. Uh, Chinese data, central banks, payrolls, not to mention that there's only a week ahead for the US elections. So there's I know this is a bit of an old story, but market is waiting for data, right? We have been seeing the market trading range bound for already a couple of months. It's getting sometimes boring. I really hope this time, particularly after US elections, not putting much faith on only in this week, we may find some better directions across the board. We may see some more interesting movements. But anyway, let's start by taking what already happened, which is that we had Bank of Japan and Bank of Australia both having their policy meetings earlier today during the Asian session. The fact is that both left their economic policies unchanged. There are a couple of things worth mention. Kuroda from the Bank of Japan said that, as expected, they delay their goal inflation target to the fiscal year 2018, meaning they will reach that goal 1 year later than they had previously estimated. So that's not good news because it's telling us that no matter how much stimulus Bank of Japan adds, the economy is still struggling to grow. And the other news, or what I understood as a positive news, is that Governor Lowe from the Bank of Australia said that inflation is not really a concern at this point in the way that it won't affect the economic policy decisions, right? Somehow he said that they are not planning another rate cut and that the current 1.5% reading could be a bottom for Australia, which is pretty interesting because it's in spite we are all expecting the Fed to act in December and raise rates. There's a good chance uh, that the rates won't go beyond 0.50, right? And in Australia, we are talking about 1.5. So in the long run, rates differential still keep favoring the Aussie. Keep that in mind when you trade, right? Anyway, another thing that was that already happened, sorry, and was quite interesting are the manufacturing PMIs and non-manufacturing PMI, in fact, released by China over the past Asian session, beating expectations, right? It's not like a shocking news, or better said, we don't have shocking market reactions, mostly because we have the Fed tomorrow, Bank of England on Thursday, non-comparables on Friday, and elections next Thursday, right? So, but anyway, the data is good. It's uh, it's signaling that Chinese growth is not as bad as we feared at the beginning of the year. Maybe it's showing some signs of growth, and therefore that should feel a bit of a risk appetite. Okay, guys, so be aware of that. That's the main reason why we're seeing some gains in the euro today and in the pound probably also. But I don't trust still the pound. I still believe that the pound is a sell the spike. Anyway, we will have manufacturing data, preliminary October readings in the US later today. So that will be the center of attention later, and they probably the events that will drop the market later today and for the rest of this Thursday. Tomorrow, of course, the main focus will be, that's the Fed, but keep an eye on the ADP reading because it will hint us how the non-farm payroll can come up on Friday. And also keep an eye on the manufacturing PMIs from Europe because they will tell us whether if stimulus is working in Europe or not. We have slightly positive readings ever since Mario Draghi launched massive stimulus last March, but still not enough to say that the economy is picking up, the region is growing, and indeed Brexit vote has harmed any possibility of recovery in the euro area. So I believe that these PMIs will probably help us determine whether the euro has found bottom around 108.50 or not. Okay, on Thursday, the attention will be in the Bank of England. Uh, there are a couple of things about this. The first one is that the market has been talking about the possibility of Carney recycling, sorry, or uh, leaving the bank on Brexit. But the fact is that so far he said that he will complete his 5-year period, so not to worry about it. The other thing that is important to remark is that I believe that the word he used was definitely. Carney says that they will definitely consider late sterling decline when they meet this month, right? So somehow he may be hinting that they are not going to take much action. Overall, we are not expecting the bank to cut rates or to add more stimulus this time because macroeconomic indicators are doing fine in the United Kingdom, and uh, I don't think he will dare to risk new measures. Uh, uh, sorry, as long as the uncertainty surrounding the Brexit remains. Okay, so I do believe that if we are going to see any action coming from the Bank of England, it could well be delayed to beyond March 2017 when Prime Minister Theresa May said she will trigger Article 50. Okay, keep that in mind. Anyway, of course, he may hint some action, he may be hawkish, he may be dovish, and therefore the pound will react accordingly. Still, remember what I said before. For me, the pound is a sell on spikes. So far, I don't see any change in background scenario of fears about Brexit affecting United Kingdom. And as I mentioned in previous coverage and many reports, the fact is that uh, we are discussing whether the UK will launch or not a hard Brexit, and we are forgetting that the UK is leaving a 28 country union, and that the other 27 will probably not allow the UK to do anything else but a hard Brexit. They won't let uh, Britain get the benefits without the responsibilities. I mentioned this before. Anyway, back to the calendar, and of course, we have services PMI in Europe, which I don't expect them to affect the market Friday itself, because, as I said, market attention will flip towards the non-farm payroll report in the US. But anyway, in the longer run, this will give us some clues about the health of Europe, right, and the European economy, and therefore will probably be worth taking into account. Non-farm payrolls are expected to rise a bit in October, right? The unemployment rate is expected to take back to 4.9 after jumping to 5.0 last month. Again, I do believe that the main attention should be on average early earnings on yearly basis, 2.6%, 0.3 monthly. We need inflation in the US to guarantee a rate hike in December. And higher salaries mean more spending, which, by the way, we have a good reading yesterday. So that's another brick in the wall of a December rate hike. But anyway, I believe that the market will pay a lot of attention to wage, particularly if the headline reading and the unemployment rate came in line with expectations and within the average of the latest month. Sorry, and of course we have also employment in Canada this Friday. Sometimes they are at the same date, sometimes they don't. But the fact is that, as usual, in my opinion, it's worth to avoid trading the dollar CAD when we have both employment reports in the same day. Okay. Anyway, let me flip to charts, going to the interesting part, for me at least. Here we are. Okay, here we are. Yeah, let's, this is the euro. Sorry, I was watching the calendar and didn't see the euro advance to current levels, but here we are. Anyway, um, I have been targeting this 110.10 region ever since the pair has bottomed here and begun to recover above 900 because it stands for the 38.2% retracement of the latest slide. The technical picture in the short term is bullish right now, right? It's short term, right? And if we can extend gains beyond this level, and I do believe that we are going to see some consolidation here. Right now, it won't be easy to shake, but if the pair manages to establish above 110 during the upcoming hours and use that at these points, then there's a good chance the pair will probably continue advancing up to 1050, 1060 price zone, which is where we have former daily highs and lows and the 50% retracement of the same decline, right? I have mentioned this plenty of time. If you take a look at the weekly chart, you will see that in between 800 and 840, we have a base of a range that has been leading the pair ever since early 2015. We have a couple of spikes below it, but have been reversed, while selling interest has been around 1460, right? Here we have 1450, 1460, a couple of spikes above again, and nothing serious. So the fact is that 850 we tested last week is a major long-term support, and the pair correcting higher, it's telling me that speculative interest is not willing, right, to break below it. If it has to do so, uh, it will be with a rate hike in the US. Anyway, and by the way, I still believe that the pair is bearish long term. I don't see this as nothing else than an intraday corrective movement. Honestly, I would like to see the pair above 1120. It's also a huge static support resistance level from long, long away. Now resistance, of course, and right now it's converging with the 61.8% retracement of the rally. So if somehow we break above this 50% and the Fed disappoints, then 1120, 1160 seems to be a possible bullish target. Okay. As for supports, 950 is for me the main support, which is the 22.6% retracement of the same decline and the level that we broke and regain to start correcting higher. If we move below it, 900 and 840, 850 are the next bearish targets. Give me a second, please. Sorry. Okay, sorry for the interruption. Anyway, and for the pound, let's go to the 4-hour charts. Here we are. As you can see, the pair has been trading range bound. Somehow it has managed to stabilize around 22. 2330 is still a huge ceiling, right? We have met selling interest ever since the pair plummeted 3 weeks ago, right? Remember a while Thursday when the pair lost thousands of pips in in some brokers and with a bunch of hundreds in others. But anyway, still discussing whether it was an algo, a fat finger, or whatever. The fact is that my low for October 7th stands at 1964. So I place Fibonacci retracement in between this high and that low. And I found out that it's 23.6% retracements. It's around 2310, 2330 is the highest. So as long as below that area, for me, the risk remains towards downside. Anyway, what I'm trying to say here is that the pair is neutral. We have no trend. The 20 simple moving average, it's flat. Price is moving back and forth around it, finding no direction. Indicators also lack directional strength. Not having too much of a view in here, I still believe that the risk is towards downside. I still believe that spikes higher opportunities to sell. We have the Fed, we have the Bank of England. We may have a wild ride during the upcoming 48 hours, but remember that after that settle, the market will probably prefer to sell the pound. Anyway, if we somehow fall back below 22, we have several lows in between 2130 and 2150. So that's a probable bearish target for today. Below that is 2082, which is last week low. Yeah. And below that, I'm not seeing much in the way towards 120, right? 80 clean pips. And for the Aussie, I have been following this daily trend line for pretty much mid-September, and the fact is that we have a couple of attempts of breaking below it after that, but still we are holding above it. Most of the gains we are seeing today are mostly due to positive Chinese data rather than the Bank of Australia leaving its policy unchanged. Of course, the fact of that Governor Lowe said that inflation is beginning to be less worrisome when it comes to affect monetary policy, help the pair to advance. Still, we are in that terrible troubled area, 77. We have been unable to sell above it ever since April. Right, all spikes above 77 have been reversed. Okay, it's we're having stones, eyes. Yeah, so if I lost connection, don't worry, guys. Anyway, uh, 77 is a major static resistance level. Any move beyond the level will be probably reversed by the market. I don't think the market will dare to break above this level and hold gains above it ahead of the US events. Of course, if you have events from this week are disappointing, we may see some follow through. 77.70 is the next resistance. If we manage to break above it, then the year high 78.13. In the longer run, this level, 74.50, is for me a major support. And there's no chance that pair will be really bearish unless it breaks below it. Of course, if we break below the trend line, open the daily candle below it, and extend further lower, then there's a good chance that the pair will probably reach this area. Yet, I still to be see a break below this last, because that will probably signal a further slides towards 72.50 in the long run. I mean, not in the short term. Anyway, from current levels, 76.40, 76, 75.70 are the short-term supports. Not expecting the pair to go below it, at least not today or tomorrow. Okay, if it does, 75, 75.30 is the next probable bearish target, and road to the mentioned 74.15. Okay, and for the dollar Japanese yen, uh, if you take a look at bigger time frames, the pair has been somehow signaling that it has found bottom around 100, but still unable to rally because market there's too much uncertainty surrounding the US, elections, rate hike in December, and I'm not mean just tomorrow meeting on payrolls on Friday. It's a lot more than that. If you take a look at stocks, they have been trading accordingly to dollar Japanese yen, being directionless. We have a good day, a bad day in the US, but trading has been extremely choppy, and that replicates in here. Anyway, what I have seen also, let me put this, it's very small, is that the pair has gained the ground above its 100 simple moving average for the first time since February this year, February, January, late January, right? So that's sort of a sign that bears have gave up, at least temporarily, and we have stalled that advance around the 200 daily moving average. So this is a critical level, okay? 105.57, I have it today. We have been at size 105.50. So beware of that level, because if we break above it, we could extend gains up to 106.60. 106.60 is a major resistance, because it's the 38.2% retracement of the what I call the Abenomics rally, right? In between the 75 low we post in 2011 and the high around 25, 125 we had on 2015. Okay, so I'm watching for that particular level. and a break above it. If somehow the pair regains this level, I do expect a recovery, a steady recovery towards 110 and even higher in the upcoming weeks, month, or whatever. In the meantime, in the short term, despite there are some bearish divergences coming from technical indicators who are entering bearish territory with strong downward slopes, the fact is that the price it keeps holding above a bullish 100 simple moving average, and the price is doing higher lows, higher highs now, well, consolidating ahead of the events. But anyway, the risk is towards the upside. As I said, 105.50. If we regain 105.10, this is the immediate short-term resistance. 105.50, 106, and 160 are the main resistance for the coming days. 104.40, 103, 90 are there. 80 there is my next support. And if somehow we've lost this last, the risk downward move will probably extend for a couple of days, and we can go down to 100, 250, 60, without actually harming too much this ongoing bullish trend, but probably taking it as a downward corrective move. A couple of words about commodities. Crude oil prices is trading at its lowest in September. It broke to a 1 month low yesterday after weekend talks between OPEC and non-OPEC. Oil producers ended up, they had a meeting over the weekend, and it ended up with nothing, right? As usual, they said that they would keep on talking. The fact is that yesterday we have news that Saudi Arabia, Iran, or Iraq are exporting around 3 million barrels a day, right? Far much more than what they were exporting a year before. So actually, they can talk all what they want about a production cut. The reality is that they are pumping more, they are selling more. The negotiations are going nowhere. So what pushed the price up to 52, it will probably take it back below 45, right? We are losing hopes. Anyway, in the long run, we have talked plenty of times about 40, 52 being the comfort zone of oil prices. Anyway, bearish in the short term. If the dollar gains momentum and will go through 46.40, there's scope to test 45 and even towards this region, 44.20, which is a strong static support. And finally, poor poor dollar today. The dollar is going down and gold is going up. It's recovering nicely. Still, I would like to see it selling above 13 to talk about an upward momentum here. Keep in mind that this latest recovery, that this short-term recovery triggered by dollar weakness, it's temporal. If the Fed rise rates, that will be a much more relevant event for gold, and therefore the commodity will fall back. The immediate resistance level is this Fibonacci area, 1292. If we regain that level, 13 and 1308, where we have multiple lows, are the next resistance, right? And given that we have little latest history around here, 1279 and 1266.30 are for me, okay, these areas are for me the next supports. Okay, guys? Okay, have to go, have to check news and see what's going on in the market. Thank you for being here. Hope it has been useful. See you tomorrow with the Fed live coverage, okay? Thank you and goodbye. See you soon.